Good morning, everyone. We're going to wait just a minute while people are jumping on. Okay, it looks like that number is slowing down now, so I'll get us going here. Good morning. My name is Josh Stripmatter, and I would like to welcome you to Stripmatter Wealth's Smart Money Management webinar series. Thank you for joining us today. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007, and we serve clients throughout the United States. Today, our presentation is titled A Current Market Update and will be presented by Brett Greenspan. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have questions, please don't hesitate to type those in, and we'll be happy to answer those questions for you. Also, we'll be sending out a replay of today's webinar via email, so if you missed something, don't panic. You'll have the ability to watch it again, and if you want to forward that to any of your friends and family, you're welcome to do so as well. Today's webinar is meant to be purely educational and not meant to be tax or legal advice, so please talk to your licensed professional before taking action. And for more information, including key disclosures, please visit our website, stripmatterwealth.com. So that being said, let me introduce our speaker today. And his name is Brett Greenspan. Are you related to Alan, Brett?
No relation.
Okay,
Not
and
sure if
he's
that's a
with
good or bad thing
Morningstar.
nowadays.
Okay. He's with Morningstar Investment Management. Brett is a portfolio specialist and serves as a liaison between the portfolio managers and the clients. He has over 12 years of industry experience, including time at Fidelity as a financial consultant and internal sales at Morningstar Investments. Brett is also a certified financial planner. So without further ado, let me introduce to you Brett. And Brett, I'm going to hand this screen off to you.
Thank you, Josh, and thanks everyone for joining us today. Excited to be here. I'm going to go ahead and share a presentation I prepared for you guys. And I'll assume if I got, nope, it looks like we're one more try here. There we go. Josh, you seeing my screen okay?
I am, Brett. Yes, I am.
Oh, terrific. All right. Well, we'll dive right into it then. The agenda for the presentation today, I want to give first and foremost a year in review for 2020. Certainly a year none of us will forget, both in our day-to-day lives and the markets. So we'll start with a year in review, then we'll focus specifically on equities, fixed income, and then look at some of the economic signals we're seeing and how that informs our 2021 outlook. And we should have some time at the end for some Q&A. So as Josh mentioned, please don't hesitate to submit those questions. Happy to answer them as they come in. So we'll start with a year in review, and we'll start with the first quarter of 2020. But before we really dive into the numbers here, I think it really helps inform these numbers to remember where you were in the beginning of the first quarter last year. We ended 2019 really positive in the markets. I think the S&P was just shy of about 30%. We had the tailwinds from the tax cuts. We had really low unemployment. So all in all, optimism was really high. But as we all remember, things turned on a dime. We hit mid-February and early March, and the market totally cratered. Obviously that was a result of COVID-19, the uncertainty associated with it. We pretty much had to put all of our plans and our lives on hold. Everything changed really overnight. And certainly there's one thing the markets don't like, and that's uncertainty about the future. And that was reflected in the performance, which was pretty rough across the board. You can see the S&P 500 down just shy of 20% on the quarter, which is a huge number. Unsurprisingly, small cap, mid cap stocks led the way in the US. Those companies typically smaller, more long-term business uncertainty. Their balance sheets aren't as strong. So it's no surprise that those were the companies that were hit the hardest. We did see outperformance relative to international equities. So we saw international equities down over 20%, both in developed Europe as well as emerging markets. Now, one thing I do want to point out is that fixed income was a bit of a safe haven, specifically government bonds, investment grade bonds. This is one of the benefits of diversification. We've been in a market environment where equity exposure, risk on trades have been the norm for really, almost 10 years at this point. So I think it's important to highlight that for those investors who have had diversified portfolios, they've got, a balanced allocation, those fixed income positions did exactly what they're supposed to do and mute some of those losses. You'll note that high yield bonds, a bit of the riskier area on the fixed income side, also were hit really hard. So I suppose you could refer to the Q1 as really a risk off trade, getting out of equities, out of those riskier assets into those more conservative assets, be it cash or government bonds. Now, in the second quarter, we saw quite a reversal. We saw unprecedented stimulus from the Fed. We saw really some green shoots about what life was going to be like with COVID. With the weather warming up, certainly here in Chicago, we were able to see our family and friends, get out of our houses, have a more firm understanding of what we were dealing with. I think we can get lost in being about a year removed from this at this point about how scary it was to say there's a virus, there's a pandemic going on. We don't know if it's transmitted over, if it's airborne, if it's from touching. There was really a ton of uncertainty still at that point. And so for the market to bounce back speaks to its resiliency, and it speaks, gives some credit to the government for really stepping in with a huge amount of stimulus to stabilize some of these businesses that were really, went from overnight 100% capacity to zero, mandated closures. This strong performance really continued in the third quarter. It was perhaps a bit more steady. It wasn't as really over the top as we saw in the second quarter, but a couple trends that I'll touch on here. You can see that large caps were continuing their outperformance over mid and small cap. We saw continued outperformance of US equities over international equities. We saw really a gap here between US growth and US value, which I'm going to touch on a bit later here, but a huge historical disparity between US growth and US value stocks that's really been, more pronounced than any time in our past, certainly in the last couple of decades here. On the fixed income side, again, pretty steady performance. We saw high yields starting to dig out of the hole that they created for themselves in Q1. So you can consider this more of that risk on trade with an appetite for risk both on the equity and fixed income side. I think it's worth pausing here as I've thrown a few numbers at you here. So let's look at the cumulative performance on the year. So I showed you quarter by quarter performance, but really cumulatively through 9/30, through the third quarter, pretty strong to say the S&P 500 in positive territory at just over 5.5%. And that was really led by those US large caps, those mega caps, which I'm going to touch on a bit later, but a couple trends to keep in mind through the first 3 quarters of the year. And again, that's going to be large cap outperformance, US equity outperformance relative to international, and really steady performance in that fixed income space. Didn't matter all that much where you were, with the exception of high yields. If you had fixed income exposure, it was doing what it was intended to do, which was offset some of that equity risk. Now, the fourth quarter was interesting, and I think it's worth talking about and diving into a little bit because we did see a reversal of some of the trends I just discussed. We saw international equities outperform the S&P. We specifically saw emerging markets significantly outperform the S&P, really a strong back-to-back quarters for emerging markets. On the fixed income side, high yields again outperforming. You saw government bonds go negative in the fourth quarter. I think this really speaks to the optimism that we were seeing from investors, from businesses, that we were nearing the end of what this pandemic was going to look like, that we'd been through the worst of it, and we could start to look forward to a more bullish 2021 and beyond. Now, year to date, you can see, or rather year to date, through year end, the S&P 500 finished the year north of 18%, a huge recovery following a 20% down quarter in Q1. That's really, I think it's hard just to wrap your head around the numbers, the fact that we dug out of a huge hole, finished so positive on the year. A couple key takeaways here again is going to be large caps leading the way. US over international, with the exception of emerging markets, which really did close the gap there, just 1/10 of a point under the S&P. But really, it's that growth versus US value. US growth over US value, a 45+% difference between those two. And it highlights the fact that so much of our returns were in really concentrated areas of the market, really unpredictably concentrated areas of the market, and really, I think, emphasizes the benefits of diversification there. Now, I want to dive deeper into equity specifically. I'll follow up with fixed income here, but I think this will help inform where this outperformance was taking place. What you're looking here is a style box breakdown of US equity markets. And these are return figures you're looking at here. Those dark shaded greens are going to be obviously those positive numbers. Those red is going to be negative. And you can see that large growth and large value, about a 40% difference there. Small growth and small value, another 40+% difference. So unless you were in these specific pockets of the market, if you were, say, only in value or only in large value, for instance, you missed out on a ton of performance. Typically, in a market pullback, you're going to see value stocks outperform growth stocks. And so there were a lot of aspects of this pullback that were really unusual. And really, again, I don't mean to harp on it continuously, but the benefits of diversifying your portfolio so that you have exposure to these different areas. You're not at risk of, say, missing out on all of that large cap exposure because you were bullish on value. It's really important to keep in mind as you're protecting your nest egg. Now, I want to go one level deeper here and look at sector performance. So you can see, again, the disparity between the top performers and those laggards. What you see here is information technology and consumer discretionary stocks. So some of your FANGM stocks, Facebook, Apple, Amazon, Netflix, Google, Microsoft, these were huge outperformers relative to the broader markets. See some middling returns in there among materials, some healthcare, which, at 13% is nothing to turn your nose at, but really not comparable to those IT and consumer discretionary companies that had such outperformance. On the flip side, you see energy all the way down negative 33.7% on the year. It's not just that we had the total drop in demand from all the various lockdowns and the incremental lockdowns, but there was also a pretty big shock that gets lost in the shuffle of the pandemic, which was the OPEC-Russia dispute, which really coincided with the lockdowns in late February, early March. What that did was it flooded the market with supply at a time when demand was also cratering at historic levels. So really a unprecedented situation for energy stocks. It's actually an area that we think has a lot of opportunity moving forward, perhaps a bit too beaten down in 2020. But again, just showing that how different the performance was depending on where you were invested in 2020. Now, I talked about those FANGM stocks, and I want to dive into that a little bit deeper. Now, what you're looking at here is a chart that shows how those, what we're calling FANGM, which are Facebook, Apple, Amazon, Netflix, Google, and Microsoft, what percentage of the S&P those made up over the last 10 years. And what you can see is if you go back to January of 2009, so coming out of the 08 financial crisis, they made up about 5% of the S&P 500, which is market cap weighted, which means the bigger the company, the more impact their performance will have on the broader index. And these companies, as you saw with the last chart, with the sector performance, they've really blown up in terms of their valuations. They are huge. And you can see that they made up just shy of 5% of the index 10 years ago. Through May of this year, north of 20%. And that's actually gone up even more. We're closer to 25% of the index is concentrated in those 6 stocks right there. So it really highlights the fact that this hasn't exactly been a broad recovery. It hasn't been broad outperformance for the entire index or the entire market. It's really concentrated in specific companies, specific sectors of the market. And you can see here from a price to fair value standpoint, so looking at the current price relative to what we think is a fair value based on their historical valuations and their outlook here, these companies are potentially significantly overvalued. A couple, you'll likely recognize most of these names, but in terms of the FANGM stocks, you'll see Netflix in there at 2.67 price to fair value. You can see Apple at about 1.5. Tesla's a new name in the S&P, but one that we're familiar with given the performance at last year at 2.27. So a lot of these companies, that have seen significant outperformance, we view as potentially overvalued at these market levels. Now, I talked about value versus growth, and that being one of the primary trends that we saw quarter by quarter and through year end in 2020. And I think this chart really illustrates how significant the spread is between those two right now. So what you're looking at here is the blue is representing US growth, the gray represents US value, And those lines represent their outperformance or underperformance relative to the total market going back to 2007. And and you can see that really, for a number of years, value was outperforming growth. It was kind of a seesaw between the two. But really, since 2009, since we saw some stimulus that was initiated then, the quantitative easing, the easier access to funds for a lot of these growth companies, you've seen significant outperformance from growth over value. Now, we haven't seen it as significant as we saw in 2020, which amounted to a 46% difference between the two. But really, you can see that this spread is blown out. It was wide and it's really exploded over the last 18 months. I think it's fair to assume that these may revert closer to the mean. We don't have a crystal ball to say when or how that will occur, but just looking at this chart, I think if you remove the identifiers here, you'd say, which one of these do you want to own over the next 10 years? I think that value would have a lot of interest there. And so just a good visual here for how wide and historically wide this spread is right now. Now, one more style box breakdown here. This is looking at the price to fair value of each of the style boxes. And you can see, unsurprisingly, certainly based on the last chart I showed you there, US growth, we see it, large cap growth rather, at overvalued at 1.13. We see mid and small cap significantly overvalued as well. And we really see the value space as the area of opportunity that's perhaps undervalued, has been left behind in this recovery. Small and mid value especially look very attractive at these valuations. Now, this isn't just a U.S. theme. We have seen valuations tick up internationally, but certainly not to the levels that we've seen in the U.S. And it's part of the reason that we think international equities are very attractive right now relative to U.S. equities. So this is looking at what we call it's the Cape-Shiller ratio. It's a cyclically adjusted price to earnings ratio. And what this is doing is comparing price to earnings over a rolling 10-year period. So we use this to strip out some of the noise that 1 quarter or 2 quarters can have on this figure. And those dotted lines represent the historical averages for each of those, which is US is blue, EFA, so Europe, Asia, Far East, or you could consider international developed is orange, and that gray is going to be emerging markets. So you can see that internationally we're either below or just at our historical average here. And really in the US, we've far exceeded our historical averages. We're nearing historical highs in terms of this CAPE ratio. So another chart and an analysis data point to highlight the fact that we are seeing historically high valuations in the US, and perhaps there should be a bit more exposure to international and emerging markets on the equity side. So going to pivot to fixed income here, which, as I mentioned, played a pretty big role in the first quarter and still should have a place in your portfolios if you're looking to be diversified, to add some downside protection if we do see, significant shocks like we saw in that first quarter there. Now, what you're looking at here is the historical 10-year US Treasury yield. That orangish line is going to represent the historical average. And what you'll notice here, this is going back to the 70s. So some of you may remember when those numbers ticked up way high, over 15% even on that 10-year US Treasury yield. But what you'll notice here is that really since the late 90s, we're trading below that historical average. And really we're approaching zero here. Really we're nearing historical lows in some cases. And I think this offers some caution if you're looking to fixed income to add capital appreciation to your portfolio. There's an inverse relationship with yields and bond prices. The yield goes lower, the price goes up. And so what you'll notice here is that there's not a whole lot of room to go down here. We think in the long term, these numbers are going to tick up here, nothing in the short term that we'd forecast, but keep in mind that there's not as much runway to the downside as there is to the upside here. I will say it's not exactly a concrete wall. We have seen internationally yields go below zero, so they certainly can. But keep in mind that the performance we've seen from some of the fixed income areas of the market are probably approaching kind of a max position here, given that yields are so low. Now, another good chart here showing how the yields changed over the course of the last year in the pandemic. What you're looking at here is the blue line represents where we ended 2019. That orange represents where we were about halfway through 2020. and the gray line represents where we finished at year end. So you can see that halfway through the year, things had really cratered. We were really low in terms of the yield there. And while we've seen some recovery, we're certainly not at pre-pandemic levels. Remains to be seen how long it will take to get to those levels. It's certainly been encouraging to see those tick up here, but keep in mind that despite the strong performance we've seen on the equity side, there's still areas of the market that we're definitely lagging behind where we were going into 2020. Now, from a corporate perspective, looking at it from corporations and how they're viewing the markets, we've seen spreads really narrow. So I want to take a step back and explain what you're looking at here. This is showing the spread between investment grade credit, so that more secure, reliable, typically lower yields compared to high yield credit. So this is going to be issued by companies with riskier balance sheets, lower credit ratings from those rating agencies. And what you'll notice here is that while these track pretty closely leading up to the pandemic, those spreads really blew out in March and April when uncertainty peaked. What we've seen and has been certainly encouraging is that these spreads have narrowed. We're right back to pre-pandemic spreads, and we're also seeing record issuance from these companies, which indicates one, that they're looking to grow their balance sheets and are looking to deploy additional cash. And secondly, that there's an appetite for that debt, that we're seeing investors step into that space to say, yes, we're encouraged by your outlook and we're happy to take that debt and hold it for X amount of years. So definitely some bullish signs here looking at corporate bond markets. Now, you heard me talk about negative yields earlier, and I didn't want to leave out international fixed income here. You can see that while the US is still above zero here, there are areas where we are negative. You look at the Eurozone, you look at Japan, you can see the UK kind of hovering around that same area. It's a challenging environment to find income in the fixed income space. It's part of the reason that you've seen so much money flow into the equity markets, is there's not a ton of appetite for, or excuse me, I should say there's not a ton of opportunity to find yield in the fixed income space. We did see that it acted as a buffer on volatility in the first quarter, but in terms of looking for income, definitely a challenging environment both in the US and internationally. Now, that's not to say there's no opportunity out there. One area that we have seen opportunity is an emerging market debt, specifically in the local currency. So what you're looking at here is US Treasuries versus emerging markets. And you can see that those yields historically are higher, but have remained higher through 2020. Those typically are countries that have a bit more uncertainty than you'll find in developed markets. And so they have to pay out a higher yield in order to create some appetite for their debt. So that's an area that we do think the risk reward is still appetizing. We've added some of those positions in our portfolios over the course of 2020. And if you can handle a bit more risk, it's still an area where you can find some yield. Now, we're going to focus on some economic signals here in the 2021 outlook, and then we should have plenty of time for questions here. But want to show, obviously, everything's kind of centered around the pandemic and COVID-19. And what you're looking at here is daily cases. I'll caution that this is somewhat contingent on the data inputs. And certainly in March and April, and really probably through midsummer, testing capabilities in the US were really hit or miss. It depends on where you were located, what the rollout was like, certainly state by state administrations having different priorities for testing. So this chart's not perfect in highlighting what those numbers look like, but showing the first wave, the second wave, and then this third wave, I think informs where we've been and where we're going. And I think the steep drop off that we're seeing here is really encouraging. Part of that is likely due to getting away from the holidays and people getting together. Part of that is due to the vaccine rollout and getting the people that are most at risk vaccinated. So all in all, really encouraging signs in terms of daily new cases. Daily deaths, obviously a more concerning chart here, but one that we have seen start to flatten out near the top. We've seen these numbers come down. Again, that's likely due to the vaccine rollout, getting those people that are most at risk protected from this virus. And at this point, it really is a race against any variants and making sure that we get this rollout ramped up by hopefully by second quarter of this year. Now, this is a really interesting chart, and I want to explain what you're looking at here before I dive into it. This is showing consumer spending by sector or by area of the market. So you can see red is representing the restaurants and hotels, yellow is going to be entertainment spending, and green is going to be healthcare. And the gray backdrop is COVID deaths. So you can see that there's these waves of the COVID deaths here. And with the first wave of elevated deaths, we saw consumer spending go way down, likely a result of lockdowns by cities, people figuring out how they're going to adjust to a life where they're not going to the office, where their kids are home, tons of uncertainty. But what I think is really interesting is that as death ticked up towards the end of the year, consumer spending stayed really steady. And I think that speaks to a couple different aspects, one of which is that we've all grown used to what this life is like. It's not so much that we've got to figure out and handle the logistics of getting to the grocery store. It's you get Instacart and you get the groceries delivered like you did every other week. And you've found ways to entertain ourselves by having safe outdoor dinners or finding restaurants that are taking the appropriate precautions. And all in all, it's really encouraging to see that despite the fact that we've seen these elevated deaths at year end, that people have come to terms with it a bit and found ways to continue spending. And that's also likely due to increased savings, saving rates being a lot higher given the lack of activity over the course of the year. Now, in terms of the labor market, really, this was an off the newspaper, I think it was the Washington Post had a chart, or maybe it was the Wall Street Journal, showing unemployment figures 31x the prior reporting in March of 2020. This is a historical shock to the labor markets here. But glad to say that we've seen those numbers revert down, where they've steadily decreased, and we're now about 4 times higher than we were at pre-COVID levels in terms of initial claims and continued claims as well. Still elevated, but definitely approaching back to those pre-COVID levels. I will say that coming into 2020, labor market was arguably as strong as it's been in a long time. Unemployment was really low. We saw the market performing really well. So it's not necessarily fair to say that we'll get back to those levels, which were historically good, but we should continue to improve. And while it may take a few quarters or perhaps years to get back to those levels, we're definitely back to levels that are certainly more manageable for the government. As I mentioned, part of the reason that companies and individuals have been able to make it through this challenging time has been the amount of stimulus that we've received, whether it was for small businesses and corporations or whether it was the COVID relief checks, hitting our individual bank accounts. You can see here that the stimulus, issued last year was as big as any stimulus since World War II. So to say it was unprecedented is not exaggerating. This was a huge amount of stimulus. You could say lesson learned from 2009 or 2008 rather, where we saw a lot of stimulus. So really encouraging to see the government step in. Obviously, future deficits are a concern, but the more pressing concern was making sure that businesses didn't go under, that everyone can continue to pay their bills, and that as we get to see the light at the end of the tunnel here with the pandemic, that we enter that in a good space. Inflation obviously is a potential concern for a lot of people given this stimulus. It's not something that we view as something that needs to be a massive concern for you in the short term. I think in the intermediate and long term that may tick up a bit, but right now it's not something that we're flooding our portfolios with tips. It's something we're certainly keeping an eye on, but not something that's a massive concern in the short term right now. So just leave you with an outlook for 2021. We think GDP is likely to rebound both this year and next year. Some of this is certainly contingent on the vaccine rollout, making sure that we can get back to normal as soon as possible. There's talk right now that we should see vaccine distribution really tick up in March and peak around May. So hopeful that we can have a really strong and robust third and fourth quarter if that is the case. Interest rates, as I mentioned, lower for longer. We've heard Jerome Powell, the Fed, talk about keeping interest rates low, not scaring off the markets with the potential for rising rates this year. And as I mentioned, corporate credit markets are back to their pre-pandemic levels. Really encouraging. We've seen a lot of new issuance, which we're glad to see, and we've seen some of that go towards financing and additional buybacks of their own equities. So broadly speaking, we do think the U.S. market is a bit overvalued, certainly relative to international and emerging markets. A lot of that is skewed by that significant outperformance of those mega cap stocks, those FANGM stocks I highlighted. And whether you're small, mid, or large, we do think value is an area of the market that is undervalued and that you can find opportunity. And from a sector level, energy getting beat up a lot in 2020, we think is an area that relative to its historical valuations is very attractive, and that tech perhaps may be overvalued given the strong run of performance it's had over the last few years. So with that, I will pause, hand it back over to Josh, and I will be here for any questions that we do have.
Brett, thank you very much. That was very interesting. I have a few comments, but I want to open it up to questions for anybody that would love to pick Brett's mind while we got him. You should have your chat feature available there that you can type into and be able to ask your question. While we wait for that, Brett, you showed that unemployment claims number of 31 times, and that just is mind blowing to me. I think back in 2008, if I remember correctly, we hit 5 million in unemployment claims, if I'm not mistaken, and that's where we're at today. So to compare that to where we're at today, it just seems, again, it's mind blowing to me that where we're at today, not only with the stock market being where it's at, but also with so many people still out of work.
Yeah, I mean, it's to say that it was an unprecedented year is really underselling it. It's not just that we had a surging virus around the country. It was the fact that we were told not to leave our homes. We were told government mandated closures of businesses, mandated headcounts in businesses. There were certainly there's continued delays in getting appropriate stimulus directly to some of these businesses. So it was definitely shocking to see those figures in call it late February and March. To see those numbers still elevated is concerning, but given where we were, I think it should be viewed in a positive light that we are trending in the right direction.
Yeah, absolutely. I mean, what a comeback that we've had. I also thought the difference between value and growth, is that the largest of all time?
I believe it is a historically widespread right
Yeah.
now. Perhaps preceding maybe the 70s, there may have been bouts where that was wider than we are right now. But even I'd be hard pressed to find a time where the 1 year spread of a 45% spread between U.S. growth and U.S. value was wider. I mean, you saw the chart there. It's blown out from what was a medium sized spread between them. Really in call it 2016, 2017 to historically wide right now.
Yeah, and it's interesting. I read the Financial News Daily, and you called it Fangum. They've called it Fang. They've called it other things, but those key stocks are really what have driven this market, and it's amazing how many people have invested into those, and the multiples that you just saw on that slide of the overvaluation of those stocks is incredible.
Yeah, it's hard to say where those numbers will go. It's almost scary to think that those could continue to grow at the pace that they have been. But yeah, it's eye-opening, the fact that those are driving the markets in such an extreme way, and that's not necessarily new to 2020. I think it was 2018 where if you stripped out the performance of just those Fangum stocks, the broader market performance would have gone negative. So it really highlights that if you don't have exposure to the areas that are driving the markets, that you may not have the same experience as an index or other investors.
Yeah, it's just amazing, and and we have obviously the things that have been going on as of late with GameStop and Robinhood, with a younger class of investors jumping into the markets and really kind of plowing more money into these stocks like never before, and so it's fascinating to see what's been going on.
I think it's
few weeks.
It's hard to point to one driver or one reason for that. I think it's sometimes overlooked that that these, I suppose you could call them mini manias, or where these meme stocks are driven up. Somewhat coincided with the reduced friction that comes along with trading. You saw, Fidelity, Schwab, TD, they removed commissions on a lot of their equity trading, and I don't think it's any coincidence that we've seen a flood of retail investors enter the market when there is no friction to trading 100 times a day, whereas you used to pay it could be $25 a trade, then it was $10 a trade, then it was $6.95, then it was $4.95, now it's zero. And so,
Right.
anyone can be a trader right now and I know Robinhood would let you trade on margin. So it wasn't even as if you had to get the money in the account right away. So I think the reduced friction to enter the market played a pretty big part there in what we saw as kind of a mania with those meme stocks.
And a lot of stimulus in their pockets to do it with.
That's absolutely right. Yeah, people sitting at home and they got a check but nowhere to spend it.
Yeah. We have a question here. David asks, does the energy sector include renewables or more fossil fuels?
Yeah, good question. It includes both. Certainly more fossil fuels, given that those are the larger companies at this point. They'll have more of an impact on the broader sector. I expect renewables will play more and more of a role there, but I'd say if you're asking about how to attribute that underperformance, certainly it's going to be that more of those fossil fuel, those energy stocks, Exxon, the names that you're familiar with, kind of leading the performance down there.
Yeah, great question. Any more questions before we wrap up today, folks? So Brett, that was very interesting, to say the least, and just unprecedented times. So it's very interesting to look at these charts and to see what's been going on for the last year, and to see that we've come out of it the way that we have. So we'll continue to do these market updates. So you're welcome to tune in, and as this year progresses, hopefully we'll see some more increases in the markets. Other than that, I think we don't have many questions, Brett. So we're going to end today, and I hope everyone has a great rest of your week. Thank you very much, Brett.
Thanks for having me. Have a good day.
All righty. Bye-bye.